Alright, what's up guys? This is Chris here from Slap Stocks. Today what we're going to be looking at is something that I think is very important to recognize and to understand when trading options. And this can really help in deciding what contracts you want to purchase and deciding what contracts are actually going to make you money and realistically can. Um, this is kind of how I decide what option contracts to look at. This is also a little bit of how I do a quick check on my own after I get a signal from the Discord to decide whether or not to enter and whether or not I think it's realistic. So first off, I want to say that this video and these talking about these average daily moves and how much stocks really move on average is something that my man Jake Burr really hammered down with me and is something that I've used a lot and has helped in terms of deciding like what contracts I really want to look at in general and which ones are currently underpriced. It's a little bit different when you're scalping and you're farther out of the money. This is just showing you, I mean, it doesn't matter if you're scalping or not. This video will help you understand just kind of what you're buying when you're buying an option contract. So let's get to it. So what I want to talk about today is just on average how much a stock moves in a day. And you can do that. You can look at the charts. You can go see them on the 1 day chart here. And you can see where they open, where they close. And it's super easy to calculate a percent move, and I'll show you right here. So let's just say the stock price is, we'll just do $100 to make it easy. So if the stock price is $100, and so we'll say, or here, let's do this, open, close, on the day, and then percent move. So so if you open, if a stock opens, let's just call it stock, it doesn't matter, Jane Doe, stock Jane Doe. If a stock opens at $100 and on average every day it moves about 5%, you know that you're looking at either to close on average around $105 or 5% to the downside, $95. So what you can do to find what the average average percent move of a stock is if you look at the open price and the close price. So say we put in 107.68, and this is something you can do pretty quickly. To calculate the percent move on Excel, it's just equals, you take the, what you call it, right here. Let's do this first, so it's just easier. We'll do dollar change, and then percent change. So for dollar change, you would just do end of the day minus the start of the day. And so that would be negative, obviously, if you went down. And then for percent change, you just do this divided by whatever you opened at, and then make this a percent. And no, there we go. And so right there, that's, as you can see here, you can format these to so pretty obviously you go up $7.68 if you started $100, 7.68% move. So why I say that this is helpful in options is, so say a stock is currently trading at 150.34 and you $150.34, and you are looking currently at option contracts that are, let's say, you're looking at contracts that are 2 weeks out. and you're looking at a strike price of $200. So what you can do, well, first of all, when you're looking at that, you can do the same thing that I did over here for percent change with this. And so you can just do this minus this, and then you can divide it by, let's get some parentheses in here. Where's that? So you can see that when you do the same thing, just your strike price, and so this isn't where the stock is currently here, but when we're talking about strikes. And so obviously, sometimes you're buying option contracts at this price, and yes, your strike might be this, but you sell way before it even gets there. And I understand that. But you can use this just to help you understand really how the option contracts are priced and why they are pricing them as they are. So if you're banking on a stock to make a 33% move in 2 weeks, which is 10 trading days, and you look at the average percent change in a day and it's 1% or 2%, you know that there's probably that option contract, one, is probably pretty cheap, even though you have a decent amount of time on it, and two, that in comparison to the stock's average move, you are buying a contract that will not be worth anything at expiration because it would have to have an out of or a better than average move. And so, again, like I said, if you feel that this does not mean that you should not buy these contracts because, as you guys know, there are a lot of other things that go into options pricing than just the exact stock price. This just can help you see exactly what you're buying and what you're looking at. So if you come here and you just look at the open and the close on the daily chart, and you can put it in an Excel sheet or just do it in your head, you can get a gist of what stocks move on average each day. And that can be super helpful for a lot of different reasons. But it's mostly helpful in just showing yourself exactly what that contract you're buying is and why it's priced how it is, because that will tell you, and that this is the exact reason that insanely far out of the money contracts, like buying contracts for PayPal, if they even had them at like 500 levels, nobody would ever pay that because the stock would have to go up more than 100%. And yes, they probably have strikes for that in super, super, super long term. I don't know what's the far. I mean, you can find that out on yourself. But that's why the closer in the money the strikes are, the more expensive the contracts are because they're more realistic to make money, and you need to spend some money. And yes, Dragon and Tekka and I mean every analyst, Dragon especially though, can turn these $20 contracts into double. But again, playing the percentages, those strike prices are usually super far out, and they're banking on bigger percent moves. So you really need the stock to start moving for it to make you money, or you need news, or you need like high volatility, earnings coming up, whatever it may be. You just need it to start moving, especially when you're farther out of the money. So this is something that is super helpful to think about just in trading in general, especially when you're trying to do a daily or 0 day to expiration. And if you look at it and find that you're buying a contract banking on it to move 10% in a day and it's never done that ever, maybe you shouldn't buy that contract. Or maybe that should just make you think a little bit about what is telling you should buy it in the first place. So that is just something that is good to think about when you're buying these contracts and even when you're holding them. That's why I tell everyone who I work with, make it so that on your Thinkorswim you can see the percent gain and not the dollar amount. That's it's huge, especially if you're scalping $40 contracts. You might look at a $10 gain and not think much about it, but that's 25%. And that's really, really good. You're beating the banks in a day, in a couple minutes. So that's why I advise you to think about the percents and take some time to look into this. That's it for this video. I hope everyone has a good one. And as always, let's go green this whole week, every day.